So hello, my colleagues, and I hope everyone is well in my Business 330 class in this very, very harsh winter so far. It's icy roads this morning. So what I want to talk about is Chapter 3, which is Financial Statements and Ratios. And this is an important chapter, okay? And we're going to do some things here. We're going to look at four important financial statements, and then we're going to look at different ratios. Now, what these ratios do is they basically give you the health of the company. So you're going to use these ratios to look at many different things within a company and see how its health is. Okay, but I'm going to try to run this 4-minute video if it doesn't get interrupted, and then I'll talk to you after the video. Okay. So I hope this video plays. I'm having a little network problems this morning.
Suppose I tell you that my friend Mark runs a business and that his business made $1 million profit last year. Would you be impressed? Most people would probably say that a business generating that kind of profit is doing well. But what if I added that my friend Mark's last name was Zuckerberg? Knowing that Mark Zuckerberg runs Facebook, you'd probably say that a profit of just $1 million was a poor showing, and you'd be right. The larger picture here is this. It's important to monitor a firm on a continual basis to see if it's achieving its goal. A firm's managers, its investors, and even its regulators rely on the firm's financial statements to assess how it's doing. And they apply a variety of tools to analyze the information contained in those statements. This chapter is about the financial statements that a firm produces and the tools that you can use to analyze those statements to judge how a firm is doing. In the first part of this chapter, we provide a brief review of the key financial statements: the income statement, the balance sheet, the statement of retained earnings, and the statement of cash flows. These documents provide the raw data that investors use to see how the company is doing. But the chapter's main focus isn't on the financial statements themselves, but rather on how you can use financial ratios to draw conclusions about a firm's performance. Dozens of useful financial ratios. They may focus on a firm's ability to term bills, on the efficiency with which it manages its inventory, on its profitability, or on a number of other dimensions. The purpose of using ratios is to tell a story about how a firm is doing. To illustrate, let me go back and explore the issue of profitability a bit more. One measure of profitability is called the net profit margin, which is just the earnings a firm generates for its common stockholders divided by total sales. To determine how profitable a firm is, or frankly to assess how effectively management is running a business in almost any dimension, we usually look at ratios in two ways. First, we conduct a time series analysis to see how a particular ratio has changed over time. The blue line here shows the net profit margin for American Airlines from 2013 to 2000. You can see that the airline actually lost money in 2013. Profitability improved for the next 2 years before falling a bit in 2016. Notice that the net profit margin fluctuated a great deal, from about a loss of 7% to a profit of 18%. Even so, there's no particular trend observable here, just a tendency for the net profit margin to bounce around quite a bit. Essentially, the story we would tell is that American is generally profitable, but it seems to operate in a fairly risky business. The second way that we look at financial ratios to tell a story is a cross-sectional analysis that compares a firm's ratios to its competitors. The red line shows the average net profit margin for the airline industry over the same period. Comparing American Airlines numbers to the industry average helps us assess whether American is performing better or worse than other airlines. Notice that the average net profit margin for the industry bounces up and down, just like the American net profit margin does, though not quite to the same extent. Here again, American's profitability, relative to the industry average, shows no obvious trend. American earned a higher net profit margin than the industry in 2014 and 15, but it lagged the industry in 2013 and 2016. So the story here is that American's profitability is more or less typical for the industry. That might be a little surprising in light of the fact that American is the world's largest airline. As you'll see that we provide a thorough analysis just prior to its acquisition by Amazon using financial ratios. What story do those ratios tell about Whole Foods' performance, and why Amazon might want to acquire the upscale grocery chain?
All right, so I'm sorry about the choppiness in that video, and I'm going to try to clean it up as much as I can. I'll do post edit, all right? But anyway, it's an interesting roadmap to where this chapter is going. So, financial ratios and financial statements have a very important role in your life, and they're important for accounting purposes. And we're going to look at management's need to see them, right? And marketing and operations, and why the stakeholders and the shareholders are interested to see how the company's doing. It gives you basically general health information on a company. And in your personal life, is to prepare your own financial statements and look at your own, how you if you're meeting your financial goals, right, and your investment portfolio. So you've got to understand financial statements. All right. So there's a nice blurb here about Kroger, right? And I think we may follow Kroger throughout this book here. And I know that Kroger recently got a lot of press because they were told to raise their minimum wage for the workers who were working during the pandemic and stuff, and they refused. And Kroger's closing a lot of their stores, which is, not very ethical. So back then in 2017, the ratios it looked like they had problems too. Okay. And anyway, if you want to read this article, here's the source of it, right? So as they say here, financial statements contain a wealth of information, but digesting that information is not easy. One way analysts put financial data into perspective is by calculating a variety of ratios, and that's what we're going to do. These ratios help give an idea of how a firm is performing, not only in an absolute sense, but also relative to its competitors. In this chapter, we're going to look at how financial ratios assess the company's performance or health. Okay? The first thing we want to talk about is, and it's usually up front, and this is what I look at, all right, is the Stockholders Report. It basically gives you a synopsis and maybe a graph of the current, the letter to shareholders here, how the company is doing, all right? So in the Stockholders Report, and it uses standardized financial information, otherwise known as general accepted accounting principles, and it follows the rule-setting body known as the FASB, Financial Accounting Standards Board, all right? All right, so there were many disclosure conflicts, and as you may have heard the term Sarbanes-Oxley, and this came about to stop a lot of disclosure and conflict of interest problems in companies, and they established a public company accounting oversight board, okay, which is a not-for-profit corporation that oversees auditors of public corporations. So basically, everyone's got to file a stockholders report if you're a publicly owned company with more than $5 million in assets and 500 or more shareholders, all right? So as I said, the letter to stockholders is what I look at mostly. It's just to see how my companies are doing. It discusses management philosophy, corporate governance, right? And plans for the coming year. And if I still want to hold stocks in that company, right? Shares in that company. All right. So I'll leave this here as an introduction, and I got to try to clean up that video, and we'll pick up here next time. All right. We'll start looking at the income statement, the balance sheet, the statement of cash flows, and the statement of retained earnings. All right. So we'll do that next. All right, everybody. Take care. Be safe on the roads.